It's amazing to think that it's 10 years since the financial crisis. Coincides obviously with the launch of the Cirilium portfolios. Now, I guess you could say, with the benefit of hindsight, would we have waited? But then if we'd waited, would we have actually got them launched? Probably not. I think the important thing to remember with the launch of the funds was keeping your nerve, retaining flexibility, and then exploiting the opportunity. We can thank the performance of Cirilium on that financial crisis. We'd never have delivered the returns were there not a financial crisis at pretty much the launch of that product. Now, entrepreneurs often say that 50% of their success is down to luck, but the other 50% is what you make of that luck. So clearly one of the most instrumental things that we did with the portfolios very early in their career was taking advantage of the opportunity within closed-end funds in the early part of 2009. So during the crisis, even the portfolios with a higher risk tolerance had a higher level of cash, but we made a very conscious decision to put that money to work in early 2009 within closed-end funds. And the reason that we chose closed-end funds was that they were trading at the widest discounts to net asset value that I'd ever seen in my career, and I'd been covering closed-end funds in excess of 10 years. Plus, many of the trusts that we were buying had a level of gearing, i.e. they were geared into the markets. If we roll forward 10 years, that's actually a minority of the portfolios in closed-end funds because those opportunities don't exist like they did at the beginning of the fund. So yes, it was certainly a challenge in the early part, but it also presented a great opportunity. There's been a lot of evolution with the funds over the 10 years. I think there'll be evolution in any industry, to be fair, but specifically with the Cirilium portfolios. Back in March 2009, they were 25 million, and today they're in excess of 8 billion, so clearly there needs to be a degree of evolution because of the size of the funds. In terms of back in the early days, because of the size of the funds, we really played with the tools that were available. So we're using open-ended funds, closed-ended funds, and a little bit later on we started using segregated mandates when they became available. I think the real evolution has been the fact that we're of a size that if the tool doesn't exist, we can have it made for us. So that's been a real key development within the portfolio. But I think the real benefits to the funds has been to keep an open mind. There may be asset classes that we initially sort of turned a blind eye to, but it hasn't meant that we weren't willing to go back and revisit the attraction of those particular asset classes. Whilst our investment process is strict, it has been for the 10 years, it hasn't changed, clearly the way we execute our process is flexible. I think the biggest highlight of the last 10 years has to be sort of having the conviction of getting fully invested very early in the period when we launched the Cirilium funds back in the funds were launched in June 2008, just prior to the financial crisis, but it was the strength of conviction getting invested within closed-end funds in sort of early March 2009 that really set the funds alight for future returns. We really focus on having a diversified approach. So in terms of the portfolios, we've always had in excess of 50 holdings. So for me, the highlight's been that we've been able to deliver consistent long-term performance, but with a highly diversified portfolio. We haven't had to rely on a single geographical region, a single manager, a single sector, single asset class to deliver those returns. So that's been one of my proudest moments, is to deliver that consistency of return with a very diversified portfolio. There have been lots of incremental wins along the way. We've benefited, like I say, from closed-end funds. We've also benefited from sort of specific sectors within the closed-end fund sector. For example, we've bought into listed private equity at wide discounts to net asset value, which has proved fortuitous. We had to wait the best part of 18 months for that value to come through. So again, it wasn't plain sailing. We've also exploited opportunities that have come our way, one example being BP. It sounds unusual for a multi-manager fund, but the reason I mention this is following the Macondo well spill, BP shares fell substantially. And I was kind of highlighted to me that many of our UK managers didn't hold BP, so we experienced quite a high level of outperformance from not holding that stock. Now, for the higher risk tolerant funds, I actually thought there could be an attractive opportunity to lock in some of that outperformance by hedging non-ownership through our managers by buying some BP. For the lower risk fund, clearly buying BP ordinary shares just didn't really sit well. But what looked more attractive for those funds was buying BP corporate bonds, which offered a tremendous risk-adjusted return. Again, we purchased those for the sort of lower risk portfolios and exploited the returns that came through. You know, we don't hold those positions now, but I think it just gives an indication of the flexibility that the funds possess and the time and resources that gives us that confidence to make those decisions. I think the biggest lesson I've learned is to keep an open mind and not be wedded to a particular style. It's very easy to sort of get caught up in the drama and noise of the news headlines, but the real important thing to do is focus on the fundamentals. We all make mistakes. Don't dwell on those mistakes. Dwell on what's going to generate future returns. Concentrate on what's working for the portfolio. I think that's the most important thing to recognise. You will not get everything right, but you need to concentrate your time and effort on the things that are working. The things that aren't working, it may be that it's transitory. Get to understand those and see if it might be even worth adding to those positions. But like I say, I think the real message is to keep an open mind, remain flexible. The unconstrained approach has certainly helped. It's allowed us to exploit opportunities that may otherwise have gone unchecked. There's been quite a few changes over the past 10 years. We've had a financial crisis. Cirilium has moved from New Star to Henderson, from Henderson to Old Mutual. But I think that's where the biggest game changer has been for me. It's been the move from Henderson to Old Mutual. The scale of funds has increased dramatically, but also the availability of resource to me has increased dramatically, from both on the investment side and from the marketing side. So ironically, despite the fact that the funds are considerably larger than they've ever been, the amount of time that I have to spend marketing and general administration is probably the lowest that it's ever been. But the thing that really gives me confidence having moved to Old Mutual is the strength of our team, the size of our team, the number of investment professionals, the number of researchers, the fact that I can actually have people sort of look at scenarios, look at managers, look at strategies, which then frees up my time to look at other parts of the portfolio. That's been the real key change for me within the portfolios. As we reach the 10-year mark, I think what I'd like to say to advisors is a major thank you for your loyalty and support. You know, we've been able to provide a long-term consistent return, but that wouldn't have been achievable without the support that we've had from advisors as investors over that 10-year period, and we are truly thankful. Looking forward, it feels as fresh today as it did 10 years ago, so I look forward to another 10 years with the confidence of having a great team around me.